Now we welcome Colin Harrington. Let me
how are you?
Let me introduce you, Colin. Colin is CEO of Zephyr Energy, an AIM-listed oil and gas company focused on responsible development in the Rocky Mountain region of the United States. I'm sure you all know about the Rocky Mountains. Previously known as Rose Petroleum, Zephyr now has a new management in the shape of Colin. He's the CEO and his team. It has a new strategy and it's funded. It recently won a $2 million US government grant to drill a research well in the Paradox Basin, which is in Utah. And Zephyr are preparing to spud the well before the year end. No doubt Colin will tell us all about that. Zephyr has recently raised $2.25 million in a share placing. And indeed, Colin has invested his own money in the project. Here we go. Colin's screen is quite slow to load. So
yes,
we've given him a few extra seconds there.
It's the transatlantic screen share is not always as rapid as you'd like. How is that? Has it come up?
The transatlantic lag. Colin, it's up and it's running and it's looking very stable. Over to you.
Perfect. All right. Well, thank you, Donald, and thank you everybody for joining in tonight. We really appreciate your time. I'll speak tonight about the background of Zephyr and what I've seen as the investment opportunity, give you a sense of the mission and the team, talk you through our primary asset, which, as Donald mentioned, we're just kicking off operational activity in, and then give you a summary of my view on value and next steps. So, Zephyr, as you mentioned, Donald, we're an oil and gas company. We're focused on the Rocky Mountain basins in the American West. Many of you will know the predecessor to the company, Rose Petroleum, which has been listed since 2004. I became involved in Rose in May of last year, and I became involved as an investor first. So sitting in your shoes, evaluating the company, and we were invited to provide investment capital and some management expertise and boots on the ground in this area. We did a significant amount of technical and commercial due diligence and elected to make this investment, and I'm now serving as Zephyr CEO. So let me walk you through the opportunity I saw then and then tell you what we've been doing since to give you a sense of our philosophy and our operations going forward. Our goal when my partners and I stepped in to make this investment, we perceived that there was a significant gap in valuation between what the market cap was and what the potential upside was. We saw a market cap that was less than what the company had spent historically on just the seismic costs of their Paradox asset. And this is the Paradox Basin, Utah. Certainly a lot less than they'd spent trying to develop and buy the leases or lease the leases in Utah over the years. There was also about just under $15 million of tax loss assets in the company, which are, from the perspective of a U.S. investor, could be very effective in helping us acquire production or near-term development going forward. And then we looked at what could be at the Paradox asset just in the Cane Creek Reservoir alone. And the Cane Creek is what has been dominantly and historically produced in Utah. And the company had a reserve report done with a 2C basis, a PV10 of the Cane Creek of $50 million. That was just $45 oil flat. That was just in that one reservoir. There are 5 other reservoirs that they see on their 3D seismic, but haven't really been understood yet. So we saw from a market cap of under $3 million, the potential to significantly increase that. But we also knew there would be a lot of work involved in getting this done. And that's what we've been undertaking over the last year. So sorry about that. So how do we bridge this valuation gap? How do we get closer to what we think the asset value is here? We've started by appointing 4 new members to the board. So 4 of the 5 board members are new. A majority of them are independent non-execs, and everybody's got turnaround experience. Everybody has deep energy sector E&P experience. We've got a new executive management team with a lot of experience on the U.S. onshore side. We've tightened the focus of the company. It was spread across geographies and sectors, and we've restructured and refocused just to get down to the core assets, which will be E&P in the American West. We closed other subsidiaries and sold off assets. in an effort to make it a clean, focused vehicle. We've gone out and gotten partnerships, and I'll talk a lot about this later, with some world-class institutions, even the US government and significant operators in the West. We've deployed a fair amount of capability of time and effort and capital into bulking up the technical resources, because our team's a big believer that location and understanding the subsurface is the biggest driver of value in this sector. So we put a lot of time and effort into that. The board has stepped up, and we've bought $1.5 million worth of shares in this company. So I think you've heard from other investors tonight in a similar vein. We strongly believe that the board and management needs to be aligned with shareholders. This board owns 20% overall of the shares outstanding. And finally, what we've done is we've renamed the company, and we've really launched with a core belief around ESG to reflect what we see as the market going forward and what the right way to operate is. So going forward, singular focus on the American West, oil and gas development, primarily Utah, Wyoming, and Colorado. We're kicking off the phase 1 development of our Paradox Basin asset, and we're drilling a well by year end there. We're going to continue to leverage larger organizations, both for capital and knowledge, because we are a small, low-cost entity ourselves. We are looking to grow, to utilize those tax losses and grow through acquisitions of either production or near-term production assets to gain additional cash flow. And we're going to be very strong and proactive in focusing on our relationships with all of our stakeholders, but particularly the communities in which we operate. So next, let me talk about the mission and the team. And these are the slides that don't give me a lot of popularity with my compatriots here in the US sector. But I think it's important to point out because, again, sitting in my investor seat, the last decade in the US onshore E&P sector has been a disaster from an economic standpoint. The US E&P industry was the worst performing sector of the public markets in the last decade. And that's stripping out commodity price cycles, stripping out COVID. There were some fundamental flaws in the business model here. One was a focus on production growth versus cash flows. You had compensation packages that also focused on production and acreage growth rather than cash flow or value growth. Acreage growth without a real understanding of the rock beneath those acreage positions. So that resulted in a lot of sub-economic drilling outside of core basins. And I think by and large, the largest single problem here was just easy access to debt, which meant that so many of the small to mid and even large cap companies in the E&P space in the US were massively overleveraged. And now you're seeing the result, a wave of bankruptcies and zombie companies that are out there. The economic side wasn't the only problem in the US. The environmental impact from the sector has been significant as well. Again, just a couple examples. Widespread flaring of gas, which not only puts carbon straight up into the atmosphere, but companies lose the revenue that's associated with that gas. Emissions monitoring that's sporadic, poor local community relationships, surface footprints that are extensive and scarring, even a lot of freshwater fracking in areas with drought. These are all practices that are problematic and are certainly contrary to what we'll do. We look at things very differently. We will be responsible developers of these resources. Two focuses: a mission to be responsible stewards of investors' capital, so low fixed costs, very little, if any, use of leverage, a management team that's aligned to get their value from share growth rather than production targets. And a goal to return capital when we can to our shareholders. And again, as 20% shareholders, the board is aligned in this view. Secondly, on the environment, we believe that ESG practices are both environmentally sound, but also economically sound. We're not going to participate in projects with flaring. We're constantly evaluating new technologies like emissions monitoring to make sure that our sites and the communities around our sites are operating appropriately. We commit to minimize our land footprint in places where we work. And lastly, and this is a key point, I wanted a very strong and independent board to sit on top of management, not only to be able to utilize their relationship and skill sets, but also to make sure that the management has the appropriate oversight. So I'll walk you through the board quickly. Bios are on the website, but what I can say is we've assembled this board not just for the skills and expertise, but everybody here has had successful turnaround experience as well, and that clearly was what was needed within Rose, now Zephyr. Rick Grant is our chairman. He was previously the CEO of one of the world's largest natural gas companies, distribution companies, that was Suez LNG. He's also had a number of very successful exits in the energy sector. And we're thrilled to have him on board. Tom Reynolds is current CEO of Scirocco. He also has significant AIM experience, significant private equity experience through 3i, and 25 years in the sector. Gordon Steen, many of you may know, again, highly experienced in the AIM sector, but has also done a fair amount with North American private investors as well. And he's been parachuted into a number of turnaround stories, including Regal and Cadogan. In each case, going into distressed entities and delivering share price growth for investors. There are independents and great to have on board. I've been in the sector 25 years, most recently co-founded a Rockies-based E&P, which is our sector of focus. We went from startup to production in under a year and then had a very successful monetization of the asset. We have Chris Eady, who has been with Rose since 2014. Now Zephyr runs a very tight, clean finance operation and has not only is a chartered accountant, but has a number of years in the sector. Gregor Maxwell is the head of our subsurface, has worked in senior roles at Chevron and Apache and RockSource, and is responsible for everything we're doing from an analytics perspective and a technical perspective. So our growth and the path forward, we're starting with this clean public shell. We've got no debt, very low fixed costs, and our current holdings are twofold. It's the Paradox Basin asset, where we have 25,000 acres. We've got a very recent 3D seismic shoot across that position. We have a partnership with the University of Utah's Energy and Geoscience Institute and the DOE, who are contributing capital and time to our project there. And that's in the form of a $2 million grant, which we're using to kick off operations in Utah. We also have an option on a horizontal development in Colorado. This is something that's alongside one of the DJ Basin's best operators and most effective operators. That's something that in the earlier oil and price environment from this year, probably not something that would have been pursued, but we are seeing costs come down across the sector in Colorado. We'll continue to watch this, and there's potential for that to be drilled in 2021. But for today, what I'd really like to do is talk about what we're doing in the Paradox, how we're taking something with a strong core, really trying to reduce risk and increase the size and the magnitude of the upside here. So Paradox Basin, as I said before, we have 20,000, 25,000 acres. And unlike what you see across most US plays, this is a natural fracture play. So what I mean by that is it doesn't utilize artificial fracturing. There's no completion at the end. So it has significant potential to improve well economics, because you're losing about half the CapEx. You're not having to spend about half the CapEx that would be involved in a standard horizontal artificially fracked well. This is a prolific basin historically, but the wells that have successfully and have been successful intersect natural fractures. And when they do that, when they hit a natural fracture, the IP rates and the ultimate recovers have been substantial. But there's been a mixed track record. It's been historically about 1 and 2, with just a little bit better than that have come in, have been economic. And that's primarily been due to a lack of technology and older geologic understanding in this basin. So recent things that change that can help improve our rates here are a move from 2D to 3D and especially modern 3D seismic, the introduction of horizontal drilling, and particularly the improvements in directional drilling, which will help target these natural fractures in a much more effective way. These technologies haven't been tested yet in the Paradox. But as I said before, the company historically has spent $3 million on a very high resolution 3D seismic shoot. And combined with some of the information that we're going to learn from our upcoming vertical drill, which is happening this month, it'll give us the insight to de-risk this area and to delineate our future development. So we're very excited about the potential here. Just to show you the production history in the Paradox Basin. As I said, it's produced since the 60s. And you can see on our chart here, Long Canyon was a vertical well, it kicked off, it's still producing today. There have been 10 million barrels produced overall from the Cane Creek Reservoir, which is one of the reservoirs in the Paradox Basin. To date, as I said before, you have high rate wells when they come in, IPs of 500 barrels or more, sometimes 1,500 barrels or more a day, but the success rates have been 50 to 60%. So what we see here in early 2001 and in 2011 were early 3D seismic surveys, which helped Intrepid and Fidelity significantly increase the production from this area. But again, as we've seen, targeting still was a bit hit or miss. Peak production in this area was 5,000 barrels a day in 2014. Since then, I would say it's really been overlooked because it wasn't a unconventional fracking play. What we've seen is most companies going and getting acreage otherwise, and there hasn't been a lot of activity on the Paradox since. So I'm going to talk about our grant here. The grant is incredibly important. It's the Department of Energy funding the University of Utah's EGI, Energy and Geosciences Institute, which is one of the leading geology research organizations here in the US. And this grant funding is going to help us by combining our 3D seismic with logs and cores that we get from a vertical well to help us de-risk the future development and improve the success rates to move from that 50-60% rate up to something much higher. And it does this at an extremely low cost to Zephyr. It also accelerates our development timeframe because it means we're going to be drilling by the end of this year. So the grant details, we have $2 million in non-dilutive grant funding. It's to be used to spud a vertical well. As I said, it's going to be this year. The overall cost of the well will be $2.5 to $3 million. We will cover the extra $0.5 to $1 million. And the primary objective of this well, as I said, is to get the logs and continuous core. But secondarily, we'll be able to reutilize this well to drill a horizontal lateral in future days. And it will significantly reduce that future drilling from 6 million down to 3 million. Just a quick illustration of what I'm talking about here. This black line is going to be the vertical well. It comes down to about 10,000 feet. It pierces a number of clastics, a number of reservoirs that are not as well understood to get down to the Cane Creek, which has been the biggest producer over the years. Once we get the logs from and cores from the Cane Creek and these other clastics, we'll temporarily abandon the well here at the 9 5/8 shoe. Now, it allows us to go back in at a later date, should we decide the logs and the cores are strong enough, and develop this out horizontally to target that Cane Creek again. It's going to significantly de-risk those efforts. And again, not only will our footprint be much smaller on the surface, but it reduces the CapEx to drill that future horizontal by about 50%. Our location, it's a current Zephyr lease. It's under our 3D seismic. There are existing roadways and an existing pad, so we minimize our environmental impact, and it's got very good highway access, close to service centers in Vernal and Grand Junction, Colorado. And as you can see, we've been out there this week completing the road works. We made sure the roads were in decent shape to bring in the trucks and tankers that we'll be bringing in, and the site prep has all been completed as well, which is the bottom 3 pictures. As Donald mentioned, we funded our portion of the commitment, the $1 million commitment, by raising money in October. We raised 2.25 million pounds, significantly oversubscribed. We had a range of old investors, including the board, new investors, and institutional investors alongside as well. Really gratified with the support, and we look forward to delivering value for them. And importantly, that fundraise unlocked the additional $2 million in grant funding. We've already brought down the first 600,000 of that to date. So to summarize and give you a view on value, just to boil it all down again to the hard numbers, for a $1 million commitment to this well, Zephyr gets to unlock $2 million of grant funding. So that's funding that has no other strings attached to it. And utilizing the 1 million of our capital, the $2 million of grant, and the 3 million in seismic that previously was shot, we think will go a long way to bridging this market cap currently just under $6 million today, to get much closer to what the PV10 of the Cane Creek is. And again, that's a 2C basis, 45 million, and that's an independent report. But more importantly, the logs that we get will help us define the 5 other reservoirs that we see on our 3D seismic. We haven't defined those yet. We'll be able to do that after we have those logs. But if they're viable, that would provide significant other upside just from this Paradox leasehold alone. So we're working hard carefully to get this well drilled. As I said, we'll be spudding by year end. You should see rig contract and permits coming very soon. The drill time is 30 to 40 days once we spud. And after that time, we'll have a 1 to 3 month period to review the data that's been acquired, to review the logs, review the cores, and to make a decision whether we'll proceed to a horizontal. If we do that, that horizontal will be aimed at a top production target. The options to finance that could come from a farm out partner, of which we're obviously in discussions. We have tax-driven investors that are considering partnering with us, financial partners as well. We'll also consider PLC funding. Obviously, everything we do is with my shareholder hat on, trying to reduce risk to the current platform and obviously make the upside as large as possible for shareholders. We're obviously also trying to seek attractive acquisitions in this market. We've got a good team to go out and deliver those. No debt, no production that's underwater today, no capital commitments that are beyond our means. And as always, our capital in terms of the management and the board is alongside investors' capital, and we look forward to growing it significantly in the coming months here. And with that, Donald, thank you, and thank you, everyone.
Well, Colin Harrington, that was an unusually thoughtful presentation from an oil and gas man, I have to say.
I thought you were going to say from an American, and that concerned me even more.
No, there are many thoughtful Americans, but that was very interesting and a real joy. Thank you very much. I thoroughly enjoyed listening to you there. Let's kick off the Q&A by asking, I sense that you don't want to give us a drill date for the spud. Is that correct? It's probably commercially sensitive, is it?
Well, no, we've said we will be spudding by the end of the year, and we firmly, expect to stick to that time frame. There's a lot of build up to this, everything from, the negotiation of the agreements for the grant funding through to permitting, through to contracting. And we have a number of stakeholders involved in this as well, including the US government. So all that being said, we're making great progress and we've assembled a really good team to help us get to that point.
So there you go. I was going to ask you, presumably that's what you're doing at the moment. You're pulling together the team and it's just about ready to go.
Absolutely. And one of the things we've done, which has provided me the most comfort as an investor, is that the single most successful company that historically worked in this basin was called Fidelity Exploration. And Fidelity had a team that drilled most of the productive wells out here. We've hired a number of the ex-Fidelity team to help us drill this initial well. So Bruce Hutchins, who was the drilling manager for Fidelity, has come on board and is leading all of our efforts. And we have a good group underneath him. So, not only is it local knowledge and good relationships already with service providers out there, but it's just I think it's the right team with a good understanding of this basin and the various, unique attributes of it. So we're happy to have this team in place.
Do you think this is more an appraisal well than an exploration well?
Yes. Yeah, I do, given the information that we have here. And again, not to downplay it, the company spent historically a lot of money on this seismic shoot. Is one of the things that attracted me most when considering to step in here. So that combined with, actual rock from the cores and electric logs from this well we're going to drill, I think will serve to significantly de-risk this project. And yes, I think you'd absolutely quantify this as appraisal. Okay.
And if you like the results from the vertical well, how long before you actually look to drill the horizontal portion?
I think, we will pursue that very quickly if we like the results from the first well, because obviously one of my fundamental drivers is getting production into this company, and conceivably with a horizontal lateral off of this well, not only are we saving half the cost, because half of it will have been already done through the grant and our initial commitment, but I think we're feeling good about the environment that we're in at this point. So we have ongoing conversations. As I said, I never want to be beholden to farm-in conversations with much larger partners, because we all know that that can be a long and drawn-out process. But I think there are enough alternatives for us here to drill the second half that we certainly would have a conversation with our shareholders about it. And we would absolutely talk with other financial partners and try to get this drilled expediently if we're excited about it.
Would that include debt and equity?
Sorry, it could.
Would that include debt and equity?
I think typically companies our size get in trouble using too much debt, particularly without other sources of cash flow here. So I'm more averse to debt, but I think there are a combination of financing structures at the asset level that could help us pursue this.
Okay, a question from the audience. Igor Afonin asks, what sort of oil have you discovered? Light, medium, or heavy?
Well, I think that's part of what we will see here from our cores. We'll get an understanding of the qualities of the oil in this particular area. But particularly, this has been high grade oil.
Okay. Now, please, this gentleman's been very polite. He's a long-term shareholder, so for him to be very polite is quite a thing. It's called Jeff Richmond, and he's been with Rose and now Zephyr for 14 years. So he's gone through a lot of misery, I suspect. Yep. He says he's more than 95% down on a substantial, oh my goodness, 5-figure investment. But he believes in you, Colin. He's bought back into the company. So multiple dilutions is part of the problem. How here we go. How confident are you of avoiding future dilutions of note? What do you see as the minimum viable oil price? Thank you. There you go. Well, he's a very patient man.
Yeah, let's take the second part first, because that's an easy one. We think that these wells will be economic below $30 oil. Again, because twofold. You're not completing them, so that saves some on the CapEx. But particularly this first well, where a lot of it will have been funded by the grant, the economics will be fantastic on the first well. I think from a much broader perspective, I think you should know, again, as a shareholder and a 20% shareholder in this company, I am extremely sensitive to dilution as well. And it's something that we will certainly work to avoid at all costs until the opportunity is right. And if we think, based on the logs and the cores, if we think this is something that a risk and with a potential reward that's, much more sizable, we think that this is the right way forward, we will come to shareholders and talk about it at that point. That being said, I do feel there are a number of ways to fund the second part of this well, and it doesn't necessarily involve dilution. And with my shareholder hat on, and as somebody whose value from this comes from growth in the share price, I completely understand where he's coming from, and am in the same seat as he is.
Okay, we're just about out of time. It seems to have really sped past, Colin. As I say, very thoughtful presentation from you. You emphasized responsible drilling, and there's, thankfully for you, there's no fracking required in this well. So no one is going to test your empathy here. But if you came across a fracking opportunity which you thought was fantastic in the future, would you consider fracking?
Sure, and I don't want to dissuade people from all fracking. It's just the nature of this project here. So I think fracking done in an appropriate way in areas where brownfield areas or areas that where it can be done properly, that's absolutely acceptable. The practices that I'm most concerned about are things like flaring, where you're just pumping methane up into the environment. or freshwater fracking, for example, in areas where there's no freshwater. I'm a big believer in engagement with this industry rather than divestment. Certain people say, don't touch fossil fuels, bad for the planet, global warming, et cetera. And I completely understand that and agree. But at the same time, fossil fuels are not going away. And I believe that if you engage with the industry, if you work and put in best practices from the inside, that you can actually, begin to make a difference. And that may sound a bit idealistic, but I think, we can demonstrate both with our natural fracture project, or also by doing, appropriate and responsible fracking projects in places where it's acceptable. Sure, of course, we would consider that for the right opportunity.
And I don't think it is entirely idealistic anymore, Colin. From last year to this, things have entirely changed.
Sure.
And I think, you heard it here first, I think ESG is becoming a mega trend.
Yeah, I completely understand it and believe it should. So I'm aligned with that.
Okay, Colin, thank you very much indeed for joining
Donald,
us.
thank you. Appreciate
Colin Harrington, CEO of Zephyr Energy. Thank you for your time.
Thanks. Take care.
Bye-bye.